Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's February 7th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you that the Eagles won the Super Bowl. Man, what a weekend. Minnesota was like minus 15. I'm not kidding. That didn't stop the Eagles fans from piling into U.S. Bank Stadium, where I would say about 65%, even more than that, maybe close to 70% of the people in the stadium were Eagles fans. If you think about it, it makes sense because it costs a lot of money to go to the Super Bowl. And since the Patriots make the Super Bowl like every year, their fans are probably like, right, enough. I went already. I don't want to go. You know, this is going to be my 8th time in whatever, 12 years or whatever it is. But a lot of Eagle fans showed up. It's a big deal. It's just really, really incredible to be there. And just watching the Eagles win the Super Bowl for the first time. I don't know if it makes it more special when they beat Tom Brady and the Patriots. I mean, I even had my close friends who are Washington, the Redskin fans, the Cowboy fans, the Giant fans who are in the same division as the Eagles, like thanking me. Say, I'm so happy for you. I'm so glad you beat Tom Brady. I mean, people really hate that guy. But what a game, what an experience. And I've been an Eagles fan for pretty much all my life, really hardcore for over 30 years. My favorite player was Randall Cunningham. My dad took me to Giants games when they played, in New York, which is basically New Jersey, where those games take place. And, so every time the Giants played the Eagles, he would take me there when I was younger. So this really meant a lot. And people say, well, it's sports. It's just a game. And, there's more important things in the world. But, just being there, seeing the Eagles win, those emotions, brought back a lot of cool memories for me. And it was just really, really special. I will say that, as much as people do hate the Patriots, they were very, very respectful fans there. They had Patriots fans thanking. They say, hey, congratulations. You guys really deserve it. You guys played a great game. The Eagle fans weren't arrogant. They weren't throwing, they were, just cheering and going crazy the whole time. But it wasn't like, hey, Brady sucks or anything like that. It was, it was just really cool. And I have a lot of respect for the Patriots fans. They were just, they were really cool. And I think when you see that moment and you see, winning that first Super Bowl, I think they understood how important it was. Where, if you're a Yankees fan, you see it all the time. Boston's been winning championships and stuff like that. But when you have a team, it was, I won't say similar. It was kind of similar to Chicago Cubs. Chicago Cubs didn't win, for 100 years or whatever it was. But really, really remarkable being there. Of course, take 4 days to go there. What happens? The market had a crash, right? which was terrible. So another thing which was terrible is I broke the curse. Since I picked the Eagles with the points, which means my guaranteed trade did not work. So for 8 straight years, I failed to pick the Super Bowl winner. It includes a spread. So every time I pick the Super Bowl, especially the last 5 years, I was telling my listeners, hey, do the opposite. It's been working every single year. It's been, it's for 8 years. And I know the last 3 years, people really started taking it seriously. But I'm real sorry about that. If I was going to lose, this was a time to lose. I'm glad I lost this one with the Eagles. I picked the Eagles because I just thought that I really thought that they were the better team. I think if Wentz would have played, they would have been favored. It's not saying anything about Brady, but I think Brady and Belichick deserve a lot of credit because this is by far the worst team that they brought to the Super Bowl. They don't have that great of an offensive line. What Brady did was amazing. You could hate him. Over 500 yards passing, it was pretty awesome. But, looking back on it, it was just it was really, really incredible. But I am sorry. I'm really sorry about the trade, the guaranteed trade. So if you took my advice and you sold your kids to put money on the Pats and you lost, give me a call. I know a few people that can help, get your kids back for you. So my apologies. But I always poke fun of it. And hopefully you guys see it as something that's fun. I'm just really happy that the Eagles won, just to be there for that event. It was an incredible experience being able to share that with my wife. It just really meant a lot to me. It's something I will never forget. So really proud of them, played their hearts out. They won that game. In other words, they didn't play to lose, which we see so often when teams play against Brady and Belichick and try to kill the clock or hand the ball off 3 times and give back to Brady. They stayed aggressive. They lost the lead in the fourth quarter, didn't lose composure. came down the field, scored that TD, which was fantastic. And then, the D finally came up big after, I don't know if anybody knows this, but there was one punt in the game. New England, it was by the Eagles. New England didn't punt once the whole game. So the defense was pretty terrible, but they did come up with a big play when it matters. They got that fumble recovery, which kind of sealed the deal. Again, just really, really awesome. But now it's back to work. So if you're a Curzio Research Advisory subscriber, you should have got a market portfolio update today. If you're a Curzio Venture Opportunity subscriber, you're going to get a market portfolio update tomorrow, only because there were a few names that reported earnings today that I wanted to dissect and analyze before sending you an update. But you will receive a game plan on how to play this volatile market, which is pretty crazy right now. This includes strategies to use to help lower your risk in a very volatile market. More important, I just wanted to send an alert telling you to basically ease your nerves, to relax a little. Because what do we do when the market does come down? You see it's everywhere in the media. You're watching CNBC, what's going on. You're looking at these different blogs, and their job is to scare the hell out of you, right? Because that creates more page views, and page views are what gets advertised to pay big bucks, to basically market on their platforms and these media platforms. Because when all is said and done, if you look at this pullback, if you fell asleep on January 1st and woke up today, the markets are flat for the year, maybe actually slightly up now if you count yesterday and today. Yet if you were watching TV over the past few days or read any financial newspaper or blog, it's like Armageddon. The world's going to end. You're in big trouble. It's crazy. Watch out for your 401k. Here it comes. It's finally here, and when I just see some of this stuff, and it's just, again, designed to scare you, and maybe it's perma bears that have been so wrong for the last 8 years finally coming out, and I get it. Just pounding the table of how this is just the beginning. You got to be careful, take a step back and look at the facts, right? Because what do? We pull back a little more than 10% from the highs. Okay. This is known as a correction, right? So you pull back 10% from the highs, not 10% of the year, from the highs. And when you look at corrections, they have taken place every single year. So we've had an intra-year move, right? Intra-year correction every single year from 1980 to 2016, right? So we're looking at 37 years in a row. We've seen a 10% market decline. Everyone's going crazy now because it was 37 years in a row, right? Where we saw an intra-year pullback at least 10%, which is a correction, but this trend ended in 2017. And then when we look in 2018, what happened? We start off with a bang, where stocks got off to their hottest start percentage-wise in over 30 years. So we look at the numbers, the market has gone up almost in a straight line from June 2016 through January 2018. And over that time, it's gone up over 40%, right? 40% in 19 months. And that's the S&P 500, guys. That's not like a stock. That's not NVIDIA. The S&P 500 is up 42% in 19 months. If you want to put it in perspective, on average, the market goes up 8% with dividends every year, including dividends, dating back to 1950s when the S&P 500 actually became, I think it was 1957, it became 500 companies. Now, a few things. One is the 37 years the market saw an intra-year pullback, right? Those 37 years in a row, which is at least 10% pullback. 75% of the time, the market ended those years higher. Interesting stat. Another thing, when you look at 2017 or from June 2016, right, through 2018, the market's gone up almost in a straight line. So if you use, just take a step back and say, common sense, we usually see a 10% pullback. Well, we didn't see it. We didn't see it for close to 2 years. So, we should expect it. You should expect it, and it's healthy. But what's important, and I'm saying, please, 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 when you see these market corrections, do not confuse a correction with a black swan event like the credit crisis. Because the perma bears have been hiding in a cave for 8 years while stocks roared higher. They're all out in full force. They say, this is just the beginning. We're going to see a massive crash now. It finally started. It bubbles everything. And I know that's scary. And why is that scary? Well, because the last time we really saw a crash was 2008, 2009. That's what we compare it to. That's in our heads, right? That's fresh in our heads. When we say the market's going to come down, we think credit crisis, the whole world's going to end. That's normal for average investors and even smart investors, guys who've been doing this for a long time, because that's what we're related to. Before that, when was it? It was 2002, 2003 that people say, oh, remember the recession then when technology stocks were, well, that was more 1999. But even when the market started roaring higher into 2007, 2008, you compare we had a mild recession, 2000, whatever, 1, 2, whatever. But the credit crisis that's a black swan event. I mean, that's something that didn't happen since the Depression. And we needed massive bailouts. I mean, that was almost a complete failure of our total financial system. You got to take that out of your head. That's not there anymore. I know people say it is. They want to say it is. They try to provide stats and figures. What they're trying to do is just sell you something. Okay, that's what they're trying to do. Because if they really believe this, they wouldn't write a freaking financial newsletter if they thought the world was going to end, right? Wouldn't they be taking their kids and put them in bunkers and stuff? Or don't use ATMs. You're going to have no cash left in them. All right, well, why are you still living in the United States then, right? I mean, just ask them that. But when we compare 2008, 2009, you have to be careful. If you look at the banks are in great shape. I know you're not going to hear that anywhere. It's terrible, and you hate the fact that they got bailed out. I hate the fact they got bailed out. I'm just giving you the facts. And they have more capital in their balance sheets than any other time in their histories, 100-year plus histories. Since the SEC requires that they have these extra reserves and they're not allowed to lend out, this would have more capital in balance sheets to avoid another type credit crisis thing. So that's very important to understand. Yet, when you look at the banks, even with all this capital on the balance sheet that they're not allowed to lend, they're reporting record earnings. We have low unemployment, an economy growing its fastest rate in 7 years, wages and earnings growing at the fastest rate in 8 years, a business-friendly political landscape, and more than $50 trillion in cash on the sidelines. That's based on what BlackRock. That's all the cash that they see. And you're talking about an institution, I believe it's over $4 trillion in assets. And that'll have $50 trillion is actual cash that can come in, but you might see a lot of that money in money market accounts, a lot of that cash in money market accounts. Either way, if you cut it in half, there's still a lot of money on the sidelines of people dying to get into this market that missed this move, which means that chances are you're going to still see these buying the dips. And you look at market risks. All right, what do we have? Rising inflation, high valuations, interest rates, right? These three risks are being talked about in CNBC every day. What does that mean, guys? Did I tell you anything about the markets over the past 10 years? If we're talking about it, it's factored in. We weren't talking about CDOs and then blowing up and synthetic CDOs and the massive amount of leverage in the housing crisis. We weren't talking about that in 2006. Nobody outside of a handful of people knew what actually existed. So when you see the risks ahead, think when it comes to the healthcare industry, right? The patent cliff. The patent cliff was huge. You're talking about hundreds of billions of dollars, right? As their patents expire, Pfizer, whether it's Lipitor, the patent expires, it goes to generics, they lose a ton of revenue. They see this date coming. What do? Well, they'll take other forms of Lipitor, and this way they get another patent. They raise their dividends, right? So they became more shareholder friendly. They put measures in place to keep, to combat some of those risks that they saw coming. It's the risks you don't see that you have to worry about, which are hard to worry about because you don't see them. But I just want to make that clear to you because you're seeing a 10% pullback in the market. That was kind of, expected, and it's just normal and it's healthy. I mean, another example is the defense companies when they were, the sequester and cutting back spending. And remember that was like, what was that, 6-7 years ago, I think, 8 years ago? They knew exactly where these cuts were going to be. So what happened? Well, we're not going to build maybe, these Air Force fighters that are great during war. We're not probably going to be in war for a while. So they started going more into the services business or building other weapons or building whatever, drones, military drones, whatever it is. And look at this, just guys, look at the defensive stocks. I mean, talking about what, I'm going to say 7-8 years ago, quote me on that, when everyone was like, oh, wow, the massive cut in defense spending, these guys are dead. No. They saw these risks coming. So, we see higher inflation coming. We're talking about these high valuations. We're talking about interest rates going higher. So we see this. Are they all factored into? No, not most, but you have to figure some of this is factored in if we're all talking about it, if we're looking at these risks. That doesn't mean we can't fall further from here. I'm not painting you a picture like, oh, guys, just go all in. We could even fall another 10% from here, which would result in stocks being at dirt cheap levels if we follow those levels. I mean, when you factor in earnings growth. So, I mean, if you look at that whole scenario, if we did fall by another 10%, we're looking at S&P 500 trading under 16 times earnings and growing earnings at more than 10% on average, which is expected for this year. So you look historically, S&P 500 trades about 15.5 times earnings. And it's tough to just give that number and make an apples-to-apples comparison because you could say this market deserved a much higher premium of 17 times, which is trading at right now. It was trading around 18.5 before the pullback. But if you're looking at today's times where we have low inflation, yes, it's moving higher, but guys, inflation is still incredibly low. Same with interest rates, much, much lower than they've ever been. Yes, they're moving higher. And then you throw in that with growing earnings at a double-digit pace much faster than in the past, we deserve that multiple has to be higher than 15.5. So if we go below that or near that with another 10% correction, what's going to happen? You better be buying a lot of stocks, a lot of good names. Because if the market corrects 20%, you can be sure there's going to be a lot of stocks down 30, 40%, individual names. Give you some great buying opportunities. So try to relax a little bit when you see this. I know your friends are asking, your family's asking, is this it? The market's going to collapse because we're programmed, social media, TV, just to make everything make it as crazy as possible. That's the point. That's why you watch more. I provide some great strategies to take advantage of this correction, which again, corrections are normal and they're healthy. You look at stocks gone up in a straight line for 19 months in a row. And if you look at the whole market, individual stocks, not every stock deserves to be trading at a premium to the markets. A lot of these should be coming down, especially in consumer staples, consumer discretionary. And these companies are trading at a premium to the market, and they're having trouble growing sales and earnings. They have very little pricing power. Margins are declining. You see more competition come in. So I know we always look at the market and say, wow, it's trading at 17 times earnings. There's a lot of names trading 20, 25 times earnings that don't deserve to be trading and should be pulling back 20, 25%. On the flip side, you have companies like Amazon or Facebook, they deserve to be trading at huge premiums to the market. And they have massive, massive growth potential still. I mean, the advertising platform for Facebook is incredible. You're looking at Amazon, forget AWS, right? I mean, that's growing off the charts where they have, 45% market share. Incredible growth in that business. You look at, of course, at dominating online retail where they could just almost buy any company and integrate into their system and control that industry if they wanted to. But now look at Alexa. Like tens of millions of devices are being sold. That's the hub for smart homes, where 10 years, every home is going to be a smart home, whether you like it or not. Every appliance being built is smart. Every TV being built smart. All the light bulbs going to be built. They're going to force you into this trend, whether you like it or not in a bad way. But the hub is Alexa, where Alexa's it's over 4,000 devices that's compatible with. And you could use that, make me coffee or put the oven on. What's the temperature? Anything. These virtual assistants. And that's a massive growth, but it's just starting. They deserve these premiums when you look at Amazon and Facebook. If you're subscribing to my newsletter, or newsletters, I should say, I got your back. I started writing these in Minnesota and on my planes back from the Super Bowl, which is 2 planes and a bus I had to take from Wisconsin to Chicago because my flight got canceled in the snow. Man, crazy. Planes, trains, and automobiles. Definitely worth it. But thank God Eagles won because I don't know if that whole trip would have been worth it, which is really cool. So be sure to read those updates since they will include some adjustments to our portfolio. Whole portfolios, we're buying and selling, actually adding to positions and selling off a few names. And also they're going to include really good strategies to lower your risk. Now, because we have a market that has pulled back significantly, which, is around 10%. And yes, it's been some markets fall 500 points open Tuesday only to finish 506 points higher, but still incredibly volatile market. I reached out to Mike Alkin, who just launched his Moneyflow Trader newsletter with Curzio Research. It's a newsletter focused on profiting from stocks that fall in value. I have to pat myself on the back with the timing of this product, by the way. So hopefully he's doing very well for you people who subscribe for it. We got a huge response to it. But in all seriousness, I want to help you out the best way I can. Right? And that means launching products, not at the top of the markets, which you see all the time. You see that with ETFs. But when I think you can make the most money from it, and I think you're going to do very well if you're subscribed to Mike Alkin's Moneyflow Trader. Almost like Barry Cohen's crypto newsletter, which we put off to next month. I don't think that can cut out at a better time. A big believer in blockchain and cryptocurrencies. A lot of garbage in that space as well, which is why I hired what I believe is the best analyst in the space. But it's going to come out the perfect time since this industry has really come down a ton, and you're going to be able to buy a lot of his picks at a significant discount to where these things traded just 2 months ago. So really excited about that product. But getting back to Alkin, I wanted to bring him on today's podcast because he's really bearish. I think stock's going to come down a lot more. And I want you, as investors, to have different opinions or get different perspective from, someone who is one of the best research analysts out there. He worked in the hedge fund industry for over 20 years. Of course, with Michael or any analyst, we don't always agree with everything, but we respect each other in the end. That makes us better analysts because we are able to learn from each other. And it also makes you a better investor just by listening to two experts, two opinions, kind of like Icon and Ackman, whether you're thinking about, either shorting or buying Herbalife. But I wanted to bring him on because he has a little bit of a different opinion than me, where I do think we could see a little bit further pullback, but it's not the credit crisis or anything like that. Michael thinks it could be even bigger. Then after I interview Michael, I'm going to have another interview for you. It's a first-time guest. Yes, I know a podcast is going to be a little bit long, but you're going to get great information. His name is Gianni Kovacevic. He's an energy expert, author of the book My Electrician Drives a Porsche. Really, really great interview coming up, guys, about the future of energy. The best ways to play several remarkable secular trends in this space. Now, before we get to my interview with Gianni, here's Michael Alkin, who's about to tell us why the recent pullback in stocks could just be the beginning. Michael Alkin, thanks so much for joining us on the podcast.
Hey, buddy. Thanks for having me, Frank.
Now, as you could hear, I lost my voice a little bit. I'm sure you know why.
God, thank God the Eagles won, because Frank, if you had gone to minus 5-degree temperatures for like 4 or 5 days and you came out with a loss, that would have really been a bummer for you.
Oh, yeah, I got it. And it was minus 15, by the way.
Minus 15. My apologies.
I used to think that minus 15 and minus 1 were the same. They're not.
They're not.
I figured that out right away. So, Michael, I wanted you to come on the podcast today because you're one of the best short sellers I know, and I mean that generally. It's amazing to see your work and you coming to Curzio Research, and I think we launched your Moneyflow Trader, which is based on using conservative option strategies to bet against certain stocks in the market. I kept telling everybody to subscribe because I think it was the perfect time to do this, and now we're seeing the market collapse a lot. So let's get your opinion on the market, because I'm getting a lot of people saying, Frank, we need to update what's going on. And you're seeing this massive volatility where the market's fluctuating down 400 on Tuesday, up 200. This is coming off of a huge sell-off over the past couple of days. What's your opinion on what's actually going on here?
Yeah. Frank, you hear me say a lot about the consumer industries and branded companies when I talk a lot about short selling. I say don't confuse a brand with a stock you should own. And I think what investors might benefit from thinking when they're thinking about how to position themselves is don't confuse an economy with a rising stock market, right? So, if we look at the headlines right now, since Trump, the cheerleader in chief, has been in charge, he's created 2.4 million new jobs, and unemployment's at 45-year lows, right? We've got small business confidence is as an all-time high. The tax cuts, you took the business tax rate from 35% down to 21%. You've got a typical family of 4 that's making $75,000 is going to see the tax bill reduced by $2,000. So on the surface, you look and say, well, what's not to like, right? But what you have to do is put this in context, right? There's the old saying, history doesn't repeat itself, but it does often rhyme, and never so much do you see that in the stock market, right? So when I think of all of those things, I look at tax cuts, I look at deregulation, I look at these U.S.-centric trade policies that we have. There's the potential for a big infrastructure spending package, all the hallmarks of what Trump is, what his plans are. But they also tend to be policies of many new Republican administrations. And if you go back to 29, look at Hoover, the market is littered with downturns that followed new Republican presidents. Right, you can look at Eisenhower in 53, Nixon 69, Reagan in 81, Bush in 01, all market tops. Right, so I look at that and say, okay, well, it's great, but a lot of that is priced in. And I look at that and I say, okay, well, let's think about the tax cuts. I look at the corporate tax cuts, and everyone jumps up and down and says, oh, we got 21% corporate tax rate. That's fantastic, down from 35. The problem with that, though, is 21% was already the tax rate that the median S&P 500 company was paying on a cash flow basis. So there's nothing new there. That's what the median company was paying, right? I look at corporate free cash flow margins for the S&P, all at record highs, right? So then I say, okay, well, how can a 21% tax rate improve the discounted free cash flow valuation of the S&P 500, the median S&P 500 company that's already paying 21%? And the short answer to that is it's not going to, right? And then the increased capital spending that comes along with all these savings. My experience, Frank, is when companies expense capital for tax purposes, the free cash flow they generate from those investments can very well be negatively impacted because there's no certainty around the return on those investments, right? You've heard me say plenty of times on the podcast or when we're speaking is always be careful of the power incentives. So if companies are spending just to save money, right, and you've got a tax benefit out of it, doesn't mean the return on those investments are going to be great. So you really have to think about the return on shareholder value from those, and I think that could be a great risk, right? And then the other thing I think about right now is you've got this rapid rise in corporate spending, capital investment, right? These are classic coincident indicators that signal market and business cycle tops. So, for me, rather than cheering the tax cuts, what I think the market should be leery of is the effects of the lower tax rates, right? Which will cause increased budget deficits, rising inflation, rising interest rates. Those are the things I think that the market is starting to think about, and those are the things I think about that I think investors should really be, focused on right now.
So you bring up a lot of good points there. And first of all, with the taxes, I wonder if you're factoring repatriation, where you're seeing, Apple come in and say, we're going to invest $350 billion now in the U.S. And you're seeing a company like Skyworks Networks today say, the results of that quarter was lower than expected when it comes to growth. It was still a good quarter. But the stock would have went down. Instead, it's up huge. And we're doing this on Tuesday because they announced a $1 billion buyback and said this is what we could do from the tax cut. This is extra, money we have, on our hands now. So is that factored in also? Because like you said, you don't know what the return on investment is going to be as these companies invest it. But now you're seeing, Skyworks come out and say, well, we'll have a buyback now. And you have but AT&T and some of these other companies are saying, Comcast, well, we're going to give, $1,000 extra bonus to our employees and stuff.
Yep.
How does that factor in where maybe that filters into the economy? Are people looking at that? I'm just playing devil's advocate. I'm not saying I agree or disagree.
Sure, absolutely.
You. So,
I think, sure, does it trickle down? Yes, we see $1,000 bonuses handed out. That's fantastic. Can that juice the economy a little bit? Yes. It goes back to what I said, though, about don't confuse the economy with the rising stock market, right? Because I think what the market's going to focus on is what the market is going to focus on is at these business cycle tops. And when you've got overheated economy, you get inflation and you get rising interest rates, right? About how low the rates have been since the global financial crisis, right? They've been next to nothing. And now they're starting to tick up. And there is concern about inflation. And the way you moderate that is by rising rates. The stock market doesn't like rising interest rates. It doesn't like Fed tightening. And we're in uncharted waters right now, right? I'm not the only person, and I'm not very vocal, Frank. I don't make big market calls. I focus on industries and companies. But when things are jumping off the page at me, this is really to me, it's the mother of all bubbles, right? You've had this central bank money printing, which is artificially inflated financial assets for 9 years. And so in a normal environment, the market doesn't like rising interest rates. It doesn't like inflation. It doesn't like the rates that are increased to moderate the inflation. But we've not seen this before. This is an experiment the last 9 years. So, to me, it's a global asset bubble of epic proportions that's coming at a time when global debt to GDP is at record levels. You go back to 97, it was 200%. You go back to 07 during the global financial crisis, it was a little over 250%. Today it sits at over 300% global debt to GDP. So, I think from a bigger macro standpoint, I think all of those things don't bode well for the stock market. And, the whole, the consumer, we could talk about that, but the consumer isn't in great shape. So there's a lot of signs pointing to a struggling consumer. So where does that money go? Does that money go back into the economy, or does it go to pay off some of the auto loans that are past due, or to go to pay some of that student debt that they can't pay? There's a lot of issues. I'm not sure it's so clear cut that it goes right back into the economy. And as for the corporate earnings, this is just the last stage of what they can do to jack and financial engineer their earnings. To me, the sign of a of a healthy company would be somebody that could grow their revenues and grow their margins organically, or even through some M&A possibly. But revenue growth is stagnant, growing a little bit. Margins, I mean, after the global financial crisis, everyone cut what they could cut, and now you've seen companies who've had borrowed at historic low interest rates. They've added debt to their balance sheets to buy back stock, which is like kind of the last stage, right? So if you're not getting a revenue growth, you've already squeezed out the margins you can get. Well, heck, let me go and see what I can do in terms of reducing my earnings by buying back my stock by borrowing at low interest rates. What's next, right? So, okay, so we got the tax break, but again, like I said, the average cash payer was 21% anyway in the median S&P 500 company. So I think, does it come down right away? I don't think anything pops right away. I mean, the last couple of days were a big wake-up call. It was a shot across the bow for the market, right? Volatility the VIX was at 10 prior to this. So there was complete complacency in the market. Whereas right now, maybe it was a wake-up call. Does it do what some of the cryptos have done in a month where it's down 60, 65%? I doubt it, right? I don't think that. But I think it's a great time for investors who have maybe more speculative positions in their portfolio than they might otherwise have had, to re-examine their portfolio and start to re-examine the prospects of a market that starts to come down. And I think people have not thought that that's possible for a while.
Yeah, it is interesting times. And just to bring up some of those times, so we went to the Vancouver Investment Research Conference, and this was a couple of weeks ago, and the focus was cryptocurrencies, right? I mean, when I say the focus, that anyone who talked about cryptocurrencies, including myself, had stand-up room only. It was crazy. You did a speech on how two sectors that are poised to come down or that are going to crash, you have to be careful of. And I went to go see the beginning of that speech because I had to speak after you someplace else. And I noticed that, you had seats there, people were there, but it wasn't as crowded as everything else. But now you have, what Cambridge did around the conference, and these guys are great. I mean, it's amazing really what they put together. Seriously, guys, I don't get paid for saying this, but they put all of our speeches are on YouTube, and a lot of people have been following me on YouTube, but they found your particular speech on YouTube that's got 50,000, 70,000 hits right now. So nobody wanted to listen like a couple of weeks ago.
Yeah, I
everybody's
had
cooking
100
now, right?
people in the crowd. I wish I had more because they would have saw me do a face plant as I tried to jump on the stage going up. But that's the last time I'll try and jump on the stage instead of take the stairs. But but no, there was a few hundred people maybe in the crowd, and I was talking about two sectors that I think are poised to crash. But what the room that was sold out that I stood in was a uranium one, because that's probably what I'm known for, as well as short selling. But in terms of shorting, it didn't have that big an interest. But since then, I think I looked this morning at 70,000 people have viewed it, and just in the last 5 days. Actually, it's interesting.
Now, Michael, before you go further too, because we're talking about shorting and stuff like that. And right away, when you say shorting, I want to bring everyone in here because people have your newsletter to understand. But you've created a newsletter that provides conservative, very easy to learn option strategies where you're not looking at the market, right? You talked about the market earlier, but you're especially really looking at, again, we all need to look at the market and understand what's going on here as the rates are going higher and people, markets are selling off a little bit here. But it's finding individual companies, and you've done it great on our podcast, and you show what you could do before you even launched a newsletter with just incredible Newell. I mean, that stock is still coming down tremendously, probably down 60, 70% from when you said that company was going to crash. But explain that where you're taking individual companies and looking at it and saying, hey, I know these guys can't meet their estimates. But the strategy, I think, when you say shorting the market, that's maybe why that's why you didn't get too many people, or it wasn't as packed as a cryptocurrency thing. But explain that when it comes to option strategy, because this is something very conservative that everyone, it's easy to learn, and you're hedging your portfolio in a market that's went up for 8 straight years. So it's smart. Yeah,
Frank, so for my 20 years plus as a hedge fund analyst and a portfolio manager later on in my career and a partner, at a hedge fund you're most of them, and we were aggressive short sellers, right? So we were betting on the fall of a stock price. But shorting has its risks because you are borrowing stock that you don't own. You're borrowing it from an investment bank, and you're selling it into the into the market. You're taking that cash, and at some point you hope to replace that stock to the investment bank you borrowed it from at a lower price by going out and buying the stock. If I shorted a stock at 50, I'd like to go and borrowed that stock and sold it, and I took $50 per share in cash. My hope is that in the future it's much lower, so I go back and buy those shares back and return those shares to the broker, and I keep the difference, right? So you want it to go down. The difference between shorting and owning a stock is if you own a stock and you're wrong, if you're completely wrong, you know what your downside is. It's zero, right? And that can happen. So if you short a stock, there's no guarantee what price you're going to be able to buy it back at in the market. If I short it at 50, am I buying it back at 60, 80, 100, 200, 300, right? You don't know. So it really is for a very sophisticated investor and someone with a lot of experience, because there's a lot of art to it. It's not just about understanding a company and the thesis. There's so much that goes into it that we don't have time to cover on a podcast. So you say, okay, well, but are there other ways to benefit that take a lot of that risk out? If I have a view, if I'm an investor and I have a view that an industry, a company, the market, whatever it may be, is going to go down, there are ways to express that view that can cap your risk. And one of those ways is by buying puts. And just to shortcut it, basically what you're doing is you're putting up a certain amount of capital to buy contracts, and you hope that you pick an expiration date and a strike price in the future. And if the share price is below that strike price, you're going to make a profit. And oftentimes, not always, but the profit is many multiples more of what the percentage decline in the stock is. If you're wrong and it expires at a price higher than the strike price, you only lose by buying a put. You only lose the amount that you invested. So if I knew that I was going to risk and could sleep at night and be comfortable losing, let's say $2,000 in an option in a buying a put, if I was right, I might make many multiples of that, or if I'm wrong, I lose my $2,000. So you know your risk. At this point in the cycle, and you and I have talked, and I just said this earlier, I don't make big market calls. The market is too amorphous. It's too big. It's global, except at times like this where I think are at extremes. But there are many companies, many industries where there are great stresses that are showing up, where fundamentals are being ignored. Notice I didn't say valuation. You don't short on valuation. You don't buy puts on valuation, because it's arrogant to think that one person, yourself, should be the arbiter of what somebody else should pay for a stock. But you short when you think the fundamentals are starting to decline. Now, the way I choose to express it is you can buy short-dated options, meaning I could go and say, okay, I think 3 months from now or a month from now the company is going to miss earnings. That's a tough game, right? It is tough to figure out quarter to quarter to quarter. What you can do is put yourself in your mind's eye as though you're up in the corner of the room and looking down and saying, okay, let me sift through all the noise and the nonsense. Here's where the company's fundamentals are, right? I always use the analogy, right, with Wayne Gretzky. He wasn't the biggest, he wasn't the fastest, he wasn't the strongest, but he was the great hockey player. And why? And when he was asked why, and it was presented to him, you're not any of those things that I just mentioned, he said, yeah, well, that everyone skates to where the puck is, I skate to where it's going. And that's how I view the put buying, right? So rather than say, okay, I think it's this next quarter, I don't know what the company has in their bag of tricks. I don't know if they're going to move a pension expense from an operating line to a below the line. And there's a lot of things they can do. It's hard to do it 2, 3, 4 quarters in a row, right? So if I'm skating to where the puck is going to be and I'm looking out into the future, I tend to like to go further out on my options if the pricing is right and I think the risk reward is right, but 9 to 12 months out, where I think the market is not yet focused on the fundamentals. Because one of the biggest misnomers to me, Frank, is that you hear people say, well, the stock market is a discounting mechanism. It's pricing in today what's going to happen 6 months from now. I think that's such complete and utter bullshit I can't even tell you. The market doesn't see past the nose on its face. So for me, I like to find those industries where I'm starting to see strain in the fundamentals, where I'm starting to see but yet it's not yet obvious to investors. And for that, by buying a longer dated put, let's say a put that I think is 12 months out, let's say, it potentially can go down a great deal at first, because the company might make a quarter and the stock might go up and the value of that put option contract goes down. I'm not focused on that 3 months or 6 months. As long as the primary boots on the ground research that I'm doing, as long as the fundamental analysis that I'm doing is validating my thesis that I originally had, I have time on my side. Now, again, like everything, I'm not always going to be right? I mean, there's sometimes wrong, sometimes I'm really wrong. You try and be a lot more right than you are wrong. And if that work invalidates the thesis, then you sell the position and you say, okay, on to the next one. But that's how I approach the buying of puts, in a way to express a negative view on companies, industries, or the market.
No, and it's great that you say, because when I look at the markets and you look at different things, I want to get into some of the sectors too, because one of the questions I wanted to ask you is, you're saying that, listen, if you have speculative investments, you want to be careful, which makes sense when the market comes down, because they're going to get hit the hardest. But I know that one of your sectors that you don't like, that you basically, you're out there. We'll talk about the auto industry in your video in a second, because we got about 10 minutes left here. But also consumer staples. And, you've been adamant saying how, these companies have basically done everything they can to inflate their earnings. And, you've picked two consumer staples in the past that really have come down a lot. And I know you have some of these in your portfolio. My question to you is, like, during the credit crisis, what happened, right? We saw where the whole world was going to end and it was going to get crazy. And what happened is people started pouring money into the dollar. So a lot of people said, wow, the market's going to crash. And their call was the dollar was going to crash as well, but it went higher, right? Because it was like the world's safe haven. So my question to you is, when you see the market come down, and say we're already down, right? We're down pretty quick, but say if it goes down even further, I agree with consumer staples and what they're doing on the books, but are people going to see that as a safe haven? Would that be the best place to short stocks in a market coming down?
That's it's a fantastic question, Frank. Because what you will see is, as people flock to the dollar as a safe haven, right? You see gold's held up really well during the last few days, right? There are certain things that people go to. One of the things with consumer staples is, with interest rates at record lows, you started to see people rotate some of their fixed income, because they couldn't get much in treasuries, or they couldn't get much in money markets or CDs. They would rotate into brands and companies they know. And consumer staple stocks are typically they're conservative. They're thought to be conservative, right? They're steady growers. They're steady cash flow generators, and they pay dividend. And so you would get what I would call yield tourists, right? So you get people who rotate their money out of fixed income into the consumer staples, and you've seen a fabulous bid. I mean, if you were a consumer staple investor over the last several years, right? The last several years, you've had huge cash flows. You've had strong earnings. They pay big dividends. I think over the last 15 years, they've generated 16% returns, which is double the 8% return of the S&P. And that's caused money to go pouring into the sector. Add to that the fact that you've got these tourists coming into the sectors, and if you look at the ETF on the consumer staples ETF, it's been a heck of a run. I mean, it's returned a couple 100%. Right. The problem is, as rates start to go up, Frank, there's an alternative to the consumer staples, right? So typically the market sells off, right? But companies that, if you looked over the last couple of days, some of the bigger consumer staple stocks were selling off as much, if not more, than the market itself. Normally, you wouldn't see that. Normally, when that market sells off, you tend to see these stocks catch a bid, because people would say, okay, well, if I'm going to own equities, let me rotate into something safe. The competing interests with these right now are rising interest rates. And so I think at some point people look up and say, you know what, these valuations are really stretched. When you look at the staple stocks, they're trading at big price earnings to growth. The PEG ratio, growth, the PE relative to the growth, they're trading at a huge multiple. And now for the first time you have rising rates in a long time. So I think rather than it catching a bid, as I call it, from a safety standpoint, it's competing with something else other than just stock rotation. It's competing with the alternative. And if I'm a conservative investor, I like to have a fixed income portfolio to complement my stocks. And I look, and all of a sudden I could get some treasuries that are higher yielding, or the rates in the bank are going up a little bit. You're competing with that. And I think over a period of time, aside from the fact that the fundamentals, I think, are starting to really come down on many of these companies, now you have competing interests.
It definitely makes sense. Okay, so I want to get to this last part here because, guys, if you didn't get a chance to look at it, you can go on YouTube and just put Michael Alkin, U.S. auto industry. It's going to up on Google. I'm glad that they started your presentation when you were on stage, not when you were walking up to the stage.
So, Frank, we've been together a bunch, but you were at my house for a barbecue, and I decided to climb up my stairs 3 steps at a time, and I fell flat on my face. And you saw me try and do that same thing at the conference, and I fell flat on my face. And I promise you, I was a decent athlete in the day, so I don't get it, but
I get it, Mike. You know what it is? Because I always say there's a big difference between 30 and 40, but 40 and 50, I don't know, man.
As they said in Top Gun, Frank, my mind is writing checks my body can't cash. So, yep.
Well, real quick, because this is going to be really cool. And I know, I believe you sent this video out. I don't know if you sent it out to your subscribers yet, but, we'll put it out so everyone can see it. But, guys, if you want to see it before that, it's great. And a lot of things that we publish, we're going to publish it to people who are paying for your research, obviously. But this is obviously online for free. Talk about something that you're about to do, which I'm excited about. This is something I didn't force you into. This is something that you want to do because you have great contacts. But you're about to release your first version of your podcast, which, it's going to start, I would say, probably in a week or so and everything. Yep. You already take your first guest. Talk about that, because this isn't me saying, hey, you need to do a podcast. I'm telling you, it's great. No. I mean, you've asked me about it. I say, listen, you're going to get attached to the people because they're actually listening to you. You're accountable. Everything's on record.
Yep.
And these guys become the biggest network, and it helps on the research end. But you're really excited. You already got a couple of these things in the queue, which is great. Talk about the podcast and what people could expect from it.
Yeah, so Frank, I am going to take people a walk up and down Wall Street, and I want to expose them to things they may not see every day. I do a lot of short selling, put buying, and we're going to talk some about that. We're going to give people some ideas from a macro perspective. It's not fair to subscribers for me to talk about individual stocks that I would recommend in the newsletter, but I will talk themes. I will talk bigger picture stuff on the short side, but we're also going to expose listeners to different ways to capitalize at different points in the cycle. So I will have hedge fund manager friends who come on talking about healthcare services and opportunities they're seeing there, a huge portion of the market that I have one guest coming up in the next couple of weeks that just is a 20-plus year Wall Street veteran, runs a healthcare services hedge fund, right? So people are going to hear ideas there. We're going to drill down into the nitty-gritty. I have a credit fund manager. So somebody who's he's not looking at the equities, but he's looking at the credit, the bank credit, and how that's trading. And oftentimes that can project where the equities are going, right? There's an old saying that the debt guys are smarter than the equity guys, and the credit guys really know where things are going. So we're going to talk about that and ways to potentially capitalize on that. We're going to talk about some restructurings. We're going to look at distressed debt and ways to benefit from that. So it's stuff that's not mainstream, but it's stuff that will be interesting. It will be actionable. It will be new. And I'm going to take the Wall Street speak right now. Remember, a lot of these guys are hedge fund guys who've been doing this for a really long time, so they may speak a different language. But during the podcast, we're going to break it down so that if somebody's not overly experienced in investing, they're going to understand what the topic is and ways that they could potentially capitalize on it. We will be touching a good amount on uranium, as that's one of probably the thing I'm most well known for is from a public speaking and analytical perspective. So it's going to run the gamut, but it's going to be light. We're talking about the title, and it's talking stocks over a beer, and it's going to be as though we were sitting at a bar having a beer, and as you would explain, somebody in any industry would explain to me what they do for a living and break it down so I could understand it. We're going to talk stocks like we were having a beer and just, try and give people new and interesting ways to think about making money.
No, Michael, that sounds great. And for anyone, I mean, we're going to blast that out to everyone. That's going to be absolutely free, guys. So we're going to blast that out to everyone on an email list. If you want to get on an email list, just go to curzioresearch.com, put your name in a box. Again, we're not going to spam the hell out of you. It's mostly providing you free research this way. Because now we're at the stage at our company, right, Michael, where we're marketing to the people that don't know Curzio Research, and they have to get familiar with us. So we have to give away a lot of free stuff and show them that we're for real in our research and everything. And that's getting on the email list. You're getting my podcast, other podcasts, a weekly breakdown, a lot of fun research for free. So, Mike, listen, thanks so much. I mean, this wasn't planned. I just came back. I wanted to get a quick update from you, and I know I'm getting the emails as well. Frank, what we do, and people are nervous seeing this market move so quick. And I really appreciate you taking the time. And I know that you're updating your subscribers like crazy right now for Moneyflow Trader. So thanks so much for coming on, buddy.
You bet, Frank. Thanks for having me, pal.
Hey, great stuff out of Mike. Love having that conversation. I know I'm going to get some emails. Well, Frank, you say one thing and Mike might say something else. This happens when you're independent operation. This is what you want. You want your analysts to speak their mind. You never want to tell them what to say. Where you look at Goldman Sachs, there's so many biases there, right? I mean, you have an economist that predicts something, and almost the whole company has to fall under that prediction. You can't have like different opinions, or Goldman thinks this and the research arm thinks this and this and that. Everyone has to, So it's almost like you're limiting the potential for great people who could be great analysts or have a different opinion. You all fall under the same umbrella with Curzio Research. Being independent, it's cool to get different opinions. And Michael's more, like I said, not so much of a market caller, but he looks at different industries. And there's two industries. I mean, you can go on YouTube and take a look at that video, which is fantastic. That he sees these industries collapsing, and I mean he tells me it's like shooting fish in a barrel with some of these stocks, and that he's choosing to short using conservative option strategies. But I wanted to tell you that I'm going to try to open up Moneyflow Trader to new investors. I wanted to see how some of the stocks traded first, because I want to make sure, volatility is an issue when you're trading options. The last thing I want to do is sell a product and it has so many people in it. And I've seen this a lot with option products, throughout my 20-year career, where they just take on more people, as many as they can. And then, that creates more volatility in these option trades, which some, like half the file can't get in and out. So it doesn't really make much sense. That's us collecting money and, but yet we're providing a terrible service because you can't even buy some of Michael Alkin's ideas. So I want to see how he recommended two stocks already in it that he thinks are going to fall in value, and most of them, these two I think are large cap stocks, and he focused on mid and large cap, which is better than shorting small caps through option strategies. So I have to see. I might open up in a month or two and see what we could do to get more people in there. It's a fantastic newsletter. It's a way to hedge yourself, and Michael's one of the best short sellers in the world. You can go back, look all that information, and look that up for yourselves. But it's hard to find someone that's better than him with his track record. He's been incredible, and happy to have him on my staff. Now, moving on. Long podcast today, but I love packing in a ton of information for you guys. So I set up an interview with Gianni, which was actually set when I was in Vancouver last month. He's an energy expert. I sat down with him. He blew me away. I said, you know what? It's a good idea for you to come on a podcast. Fantastic ideas. He's one of the leading authorities when it comes to electricity and how to invest in it. Gets paid a lot of money to speak at conferences all over the world. And you will see why so many people listen to him right now. Gianni Kovacevic, thanks so much for being on the Wall Street Unplugged podcast.
Nice to be here. Very nice to be here.
So I'm going to ask you to do the real difficult thing here, which is something I hate doing. I know that you hate doing, is you're a first-time guest, best-selling author, which is the name of the book is My Electrician Drives a Porsche, considered an energy expert. Why don't we start off by just telling us a little bit about yourself, quick intro, which I know is always difficult to do, but since you're first-time guest, we'll bring everyone in here, and then, they get to know you a little bit better.
Yeah, thanks a lot, Frank. Well, I follow energy, and I followed energy now for about 20 years. And when you talk about energy, that, of course, is people think oil, but it's also power systems. My first 10,000 hours of experience was studying global power systems. And basically, when you look at the way energy is changing now, we have to look at three different buckets. You have to look at the oil business. You also have to look at the power business. You have to look at the various jurisdictions, because Japan is different than China, is different than Europe, is different than America, is different than emerging markets. And then you also have to look at the utility of energy. We as consumers, government, industry, it's changing. whether it's technology and innovation that's pivoting this type of energy, or there's governmental pressure, which is forcing people to change the way they utilize energy. And this has turned everything on its head. And I think that's where people, I think, sometimes are not looking at the winners and losers in this transaction.
Well, Gianni, we've heard this story before, right? Well, we got alternative energy, different forms of energy, and it seems like in the past it's always fall flat on their face. But now you're seeing the fundamentals make sense. You're seeing a lot of different things. What has you so excited today over the past 20 years, where you've seen like a lot of head fakes? Now it's Tesla's out there, electric cars. I mean, you're seeing a massive movement, even solar, wind that work. But what are you seeing right now that makes you think this isn't just going to be temporary, like it's here now to stay, and this is a big change, a fundamental change in the landscape of energy?
Well, let's talk about this stuff as technology. And we know that the microchip doubled every 18 months, every 2 years. And they did that on and on and on. I will suggest to people that green energy is technology, and the application of it, where even though I went to the British Columbia Institute of Technology from 1992 to 1996, and we did, in fact, learn about this stuff. Unfortunately, almost all of it was fairy tales. I don't care if it was solar power, wind power, the electric car, batteries. All of a sudden, creeper, the last 4 or 5 years, this stuff is commercially viable. This stuff is cost effective. We're seeing the sort of the bidding for solar parks and wind parks. These things are competitive with incumbent energy. Of course, it needs to be tethered with baseload power, and we get into that later. But this is no longer a contest of is it commercially viable. And then those pesky guys in Silicon Valley that decided to make an electric car that's got cool factor and utility factor, and then they went and bought this solar roof company, and they've been developing these goofy battery systems, and they decided to build the world's largest battery factory. All of a sudden, if you just sit for a moment and think, look at the gravity of what has occurred here. And look what they're doing now in Australia, where, of course, I'm talking about Tesla. I'm being a little bit cheeky here. But they're now going to build the first community, 50,000 homes in a part of southern Australia, that's totally off the grid, because all the roofs are going to be solar. Every house is going to have a battery, and this community will be stoked with many electric cars. That's off grid. It works. You could argue, you still talk about the economics of this, but, there's cost and there's price. And if you're looking at the longer run, you don't care what it costs or what the price is today. What's the life cycle of this product, and how much money are you as a consumer or industry? What's the long-term benefit there? So basically, this time it's different. All of these things have come together like a pincer, and the single biggest, beneficiary of all this is, guess who, Frank? You, the consumer.
It's kind of amazing when I look at it. This is what your book is about, right? My electrician drives a Porsche, where, you hopped in a Tesla, and I'm not too sure if I got this right, but you hit like 25 cities, and you're telling us, and you're basically documenting it and stuff. I think it was 25 cities. Maybe it was more than that. But it's more than just Tesla now. I mean, I just came back from the Consumer Electronics Show, and you say, well, Tesla electric car. Every single one of them had electric car. And not only that, I always thought Tesla had a huge advantage because it's a beautiful car. I've never seen anyone that drives a Tesla talk bad about it. It's a great product for them. Again, let's not talk about the company, but what's actually happening in the entire industry. So you say, okay, electricity is going to be, I guess what my concern is, I think everyone else too, is talk about electricity, not to the point where we're going to get into cryptocurrencies, because that uses a lot of electricity too for data mining. But when you see cars, it's not just going to be cars. How everything, so much power. Who's the winners and losers? Because as more power is going to electricity, there's other, it's going to be less maybe oil use or natural gas or whatever. What are you seeing in the fundamental landscape of this industry? Because, again, it's not just Tesla now. You have every single auto manufacturer across the world that's building electric cars.
Exactly. Last year, about 90 million automobiles were manufactured and sold. And for those that don't know, China by far is the world's largest automobile market. There are about 28 million units now. So almost a third of the automotive business now takes place in China, both from a manufacturing perspective and from a consumer perspective. Tesla opened up all their patents. Their goal is to get to 500,000 annual sales. Okay, this is a rounding error. You're right. All the incumbents who have been shamed, frankly, they were embarrassed by what's been taking place with some of these technology companies. And it's no longer lip service. They are pivoting their entire sort of modus operandi, building their businesses forward, is all towards technologically advanced vehicles. And that comes with fuel efficiency as well. It's not just going to be the electric car, but the average internal combustion engine automobile in the world is going to be 25% more efficient in the next sort of 7 to 10 years, and a power of magnitude thereafter. And it's all because of technology and innovation. And if you get to, and you boil it down, and I drove a Tesla across America to do my book tour. Now, I did this to talk about energy. It was kind of a publicity stunt, and I'm not a proponent or I wasn't paid or I wasn't compensated by Tesla by any means. I simply did this process. We bought a Tesla. I started in Toronto, drove to Boston, all the way south to Florida, back to California, back up to Vancouver. I did it to prove a point. The future is now. It works. And I love to sit together with people that were experts in energy, particularly my 10 or 11 days in Texas. You could imagine when, some of the good old boys in the oil business, as they say, and they would say, oh, you're preaching this or you're promoting that. No, I'm not. I'm an energy guy. I'm one of you. I'm an oil guy. I understand the oil business as good as anyone in Calgary or Houston. I can talk about the details. But I'm also an investor, Frank. And when the facts change, so do you. So when you look at the negativity with respect to the electric car, one of the famous ones is that if you own an electric car in the United States, you fuel it, the electricity comes from fossil fuels. I mean, this is just so patently false because, albeit true, if you live in West Virginia and the local electricity source is probably going to be thermal coal-fired electricity, probably, but increasingly the future of energy in the United States comes from other sources. Only 30% of America's electricity today is derived from thermal coal, and that's predominantly in the coal-producing regions. Coal has been displaced by natural gas because of economics, period. It has nothing to do with being a capital G green or being an environmentalist. But on top of that, you have areas where solar power and wind power, I'm talking about places like Texas and places like California, it's the cheapest way to provide electricity now. Absolutely. And then you augment that for the peaker power, not with thermal coal, you do it with natural gas. We have in the United States of America 100 years of reserves now, thank goodness, and it's the best peaker power. When you need that power, natural gas is a light switch. Thermal coal takes about a week to turn it up and down. Nuclear power takes about 30 days. So in the Northwest, we have hydropower. So the future of charging your electric car, I don't care where you are in the United States, it's probably natural gas fired or wind fired or solar power, but in the future, it's going to be increasingly so renewable energy because that's where the trajectory is taking us.
Now, as an investor, and I want to say this, I'm saying this myself because, speaking to you and doing a lot of homework on you and getting to know you over the past few months, you're one of the leading authorities on electricity where you speak around the world on this subject. It's an industry you've obviously been in almost, your entire career. What are the institutions saying to you? And you just said Texas, of course, right? That's great that you gave the extreme example of guys that are just oil. But you travel internationally. What are some of the institutions or even different countries? What are they looking? Not only is electricity, but I know they're asking you, okay, what's the play on this? What's the best way we could put our capital? And maybe it's not electric cars, and some people might see that electricity and stuff like that. But there's other ways of play that I know you have been getting into. What are they thinking? What are they talking to you about?
Well, picture in the theater of your mind. People are listening to a podcast right now, and if you could picture a flattened map of the world, and if I was to enlarge all of the countries that benefit from the exportation of crude oil, and the higher the price of crude oil, the more exportation income they have, you would see sticking out would be countries like Saudi Arabia, Iraq, Libya, Angola, Venezuela. These are all countries that benefit from a continued usage in crude oil, including a higher price to make lots of exportation income. That's not the future. The other side of the coin are all the countries that do not want to continue importing oil ad infinitum. Now, countries that would stick out now, that countries that want to get off of oil, you would have countries like Japan, China, Germany, Italy, the UK, even the United States. they have a global energy mix that they have to deal with. And let's talk about the largest economies in the world. Let's talk about Japan. Let's talk about China. There is going to be many pillars that anchor anyone's energy system. Okay? There is going to be growth, more people consuming more things. You always have to look jurisdictionally. What is the endowment that this country has? Japan has no natural resources. They end up importing almost everything. Now, we know what happened with Fukushima in 2011, and they turned off all the nuclear power plants. They have a generating capacity of 290 gigawatts of power, Japan. Okay, so for those that are not enlightened with power systems, your typical large power plant, I don't care what it is about 1,000 megawatts or 1 gigawatt. Very simple, easy number to remember. Large power plant, 1 gigawatt. Japan's installed capacity, which is 290, that went down to 240 because the 50 gigawatts that they would derive from nuclear power turned off overnight. What's the future of Japanese electricity, Frank? Natural gas, LNG. This is something where the world has many jurisdictions, 100 years of reserves. But let's move over. Let's go to the world's largest energy market, China. So if we can understand what's happening in China, because remember, the Chinese no longer want made in China. They want innovated in China, then manufacture it, and then sell it to the world. So what's happening there is very important. It's the largest growth market. It's the largest absolute energy market. What has changed there? So can I just continue on this theme while we're before you ask me another question?
No, definitely. No. Go with the China theme. I like it. Good.
Let me enlighten people to what's taken place in China. I've been there numerous times. I've seen the growth in China. China has 1.4 billion people. The United States has 330 million. They're the same size. They're both about 9.5 million square kilometers. China's installed electrical capacity today is 1,550 gigawatts and climbing. It's changed. Most people liken the power systems of China with thermal coal. That is no longer a growth business in China. They're now going to be pivoting towards something similar that has happened in the United States. What I'm talking about, coal to gas conversion. They're also installing just an incredible amount of renewable energy. I'm talking about wind power and solar power. So in the past 10 years, China has installed in excess of 150 gigawatts of wind power, over 100 gigawatts of solar power. But just think of the magnitude of that. They've installed so much wind power, they have curtailment issues. They can't even effectively utilize it. They're now going to be augmenting that renewable power, which is going to continue to grow, with natural gas. They only had 100 gigawatts of natural gas installed power. This is going to climb, and it's going to continue to climb at the behest of everything else. They are the ones that negotiated to build a power pipeline from Russia. It's called the Power of Siberia. They did that with Mr. Vladimir Putin. That pipeline will be complete in the end of 2019. There are 2 gas pipelines coming in from the stands. There was all that trapped natural gas in Tajikistan, Kazakhstan, and this area. The Azeris would never let it through the Caspian. That's coming into China now. Oh, and guess who negotiated and is financing the parallel gas pipeline to the Trans-Alaska pipeline in the state of Alaska? The Chinese. So all that LNG is now going to travel to many points, but predominantly to China. The North Australian LNG, China. Qatari LNG, China, Japan. The future of Chinese electricity, and they're going to need a lot more electricity, is not going to be coal. They've capped out their hydro capacity at 360 gigawatts. And I don't even believe it's going to be nuclear power. They, too, are going to be pivoting to other things that you build a lot quicker. They're a lot more cost effective. And the future is going to be this system. And why? Because transportation in China is going to be electrified. They need to provide a tremendous amount of electricity for the future of transportation there. They also need to get people off of boiling water at a commercial scale and heating their homes in wintertime with thermal coal. And you do that by providing more electricity, and that electricity will come from the 14 million volt lines they've already built from the hinterland to the cities on the eastern seaboard. In a nutshell, increasingly, the future of Chinese energy is going to be less so thermal coal and oil, and more so things that make electricity and the utilization of that electricity. And it's all of the above. And of course, the biggest winner in this transaction, Frank, is copper.
Talk about that, because that's a big story. I think that people and you're putting your money where your mouth is. Where you have, it's a small company. It's Copper Bank Resources. I know you have you have a lot of money of your own invested in it. It's a small market cap for Copper Bank, but that's how much you believe in this trend where copper is going to be a massive beneficiary. Talk about real quick, in layman terms, right, about the fundamentals used for electric and all types of electricity, because it seems like nobody's really talking about this as much as they should.
That's correct. And first of all, it's demand growth, customer growth. Is this commodity or that commodity in the next 15 or 20 years, will you have significant new customer growth, demand growth? And the answer is the winner of this marathon will be copper. So if you look at the big five commodities, thermal coal, iron ore, natural gas, oil, and copper. Natural gas is going to continue to grow, demand for it. But the winner by far is copper. There is going to be between 40 and 50% new demand for copper simply because the utility of copper in all of these things we talked about, it does not matter how you skin the cat. The greener and cleaner that we create and utilize energy, the more that is demanded in copper. The average electric car, 400% more copper. The average solar park, 400 to 600% more copper. A wind park, 500% more copper per megawatt. An offshore wind park, 1,000% more copper per megawatt. The very thing that makes it possible to go away from fossil fuels is deluxe electricity, and that electricity requires copper. But the supply is totally, completely inverse. And if I could suggest to people that oil, the dominant commodity, usually it's like a monolithic group. And just anyone can correlate a long-term oil chart, 20 or 30 years, to any of the other major commodities. And they kind of go up together and down together. That's now decoupled. Copper has now decoupled from most commodities. And maybe that's a little bit of catch up, but it's going forward. Where do we go from now? And the opportunity, of course, in copper is the optionality. Because we have not built any new copper mines. There has been no horizontal fracking renaissance like we saw with oil and gas. We can go to all those old fields and apply the new technologies, and you could extract more juice from the reservoir, or you can go to new fields. We have this for oil and gas, but this doesn't exist for copper. When you look at the investment, the $1 trillion that was invested in mineral exploration in the past 12, 13 years, 300 billion went to the to the coals. 300 billion went to the iron ores. Very little of that went into the exploration of copper, about 150 billion. But Frank, they never found anything. We've had no renaissance. The future of copper mining is going to be deeper. It's going to be lower grade. It's going to take longer. It's going to be at higher elevation. It's going to be farther from deepwater port. It's going to be in jurisdictions that don't have a sense of legacy copper mining. This is a fantastic sort of alignment of planets for the investor, and it's called optionality. We've done it through previous cycles, but I've never seen an opportunity where you don't have to argue like some of the hot button commodities, like uranium, for example. Like we don't know what's going to happen with the future of nuclear power, or God forbid there should be an accident at one of the 447 reactors. And I'm not against uranium or nuclear power. I think it's magnificent, but there are sensitivities. The beauty of copper, we didn't find any more copper with all the exploration. It takes longer to build. There's a tremendous amount of optionality. And the best part is it does not matter which way that industry, government, society goes with respect to the application, utility, or generation of energy. Copper wins across the board. The only question is how much more copper will we use in each of these applications? So I'm suggesting to people, it's time to pivot. It's time to allocate capital into copper, and you can do it through the few names that have exposure to copper, like Freeport-McMoRan or First Quantum. But if you want optionality and if you want to make a disproportionate benefit, you need to go to down the food chain to the well-managed, well-financed, deep optionality plays within the copper juniors. And I can suggest not just my own company, but other things. There's a basket of companies that I think people can participate in.
Yeah, once again, and I like to say that, you didn't even mention your company, guys, Copper Bank Resources. And, again, it's not plugging or anything, but you're making the case to buy copper. And what stage are we in when it comes to this trend? Basically, what inning would we be in? Because we hear about uranium, but it's still, yes, prices are down and prices need to come higher. But you're looking at the amount of capacity coming online from China. And you hear, 3, 4, 5, 7, 10 years. You look at other, I've heard population growth as a theory that could be for any market anywhere, and yet that takes a long time. But the demand that you're seeing for electrical cars, it seems like this is happening right now. This is a trend where you're going to see copper prices go higher. But what inning would you say that we're in terms of, getting invested in these copper stocks, which have moved off their lows and copper's gone up, in terms of, how long this trend could be? But what inning do you think we're in?
The baseball analogy is a good one. The problem is in baseball, it can take a long time to get through the 7th or 8th inning. I liken it to a play. A play has 3 acts or maybe 4 acts, and each act has 4 or 5 scenes. We are officially in the final act, probably scene 1 or scene 2. All of a sudden, it's almost like a Quentin Tarantino movie where all the dots connect, and all of a sudden, it becomes a page 1 story. And as you and I both know Don Cox, and he always told people, investors, never invest in the story on page 1. That's the efficient market. Always invest in the story on page 16. That's headed to page 1. And I can assure people, because I do a lot of traveling, and I've been able to pique the interest of many influential global investors, so-called generalists. They're now coming on side to this whole theme of electrification and, of course, the king, which is copper. The timing is now. I will suggest to people that as we're now in February of 2018, and this is important for people that listen to your podcast through archive, the year 2018 is a pivotal year because this is the year you position. I remember, and we can all sympathize with a market when it turns. It's like a school of fish. All of a sudden, it just goes the other direction. And it's really hard to chase these stocks because when they're gapping higher, who the hell wants to jump onto that? You need to start taking your core positions, and you need to start doing that now. And if I could just give one quick plug to Copper Bank, because people always ask me, and rather than have a bunch of emails later, Copper Bank was built by a group of investors that wanted to have deep optionality to copper prices. We did it during the bear market. We bought 3 projects, all situated in the United States, that didn't require any large capital expenditure. And we would wait until the market normalized, and then we would feed those projects as inventory to other more senior companies and multiply the share position of all of our shareholders. We are now executing that business model. And if you talk about the optionality offered in our projects, the company that we're aiming to spin off first, which is called Contact, it's on private property in the state of Nevada. And my friend Frank Holmes has been telling me, he did the forward in my book, he says, you have to start articulating to people what is the optionality opportunity. So at a low copper price, the NPV of our Nevada project is 0. However, when it climbs to that economic level, and the studies that were done in 2013, Frank, it was $3.20 copper makes our project economic. We have almost a 30% IRR, a very good NPV. It's over $100 million US with a low capex to build the project. But the optionality, every 10 cents that the copper price goes higher from 320 is over 20 million on the NPV of that project. It has massive torque, massive optionality. That is why we're looking to spin it out for our shareholders as a dividend. And that is why we have numerous companies looking to take that project on. It's the optionality. Think of that. Think of the torque there, Frank. Every 10 cents, over 20 million in the optionality to that project. And Copper Bank has 3. So I encourage people to go to our website, copperbankcorp.com. You can look at the insider buying. And of course, you can find me at a conference. I keynote most of them. And we have a treasure trove of videos on the website talking about energy. I've got people like Bill Gates and Jeff Bezos and all these people that have talked about energy. They understand the relevance of electricity, and you can go through that for hours and hours. And I think you'll find it highly entertaining as you build your foundation Why copper and why now?
Well, Johnny, we'll leave it there, buddy. And listen, I appreciate you coming on the podcast. I'd love for you to follow up to maybe usually have people come on every quarter or so because this is a trend that I love right now. It's fantastic. You're seeing the demand right now, and I really do believe people can make money. I like having one of the best people in the whole entire industry, one of the most knowledgeable, come on it and help my investors try to invest in this trend. So I really appreciate it, buddy.
Thank you, Frank. Safe travels.
You got it. I'll talk to you soon.
Okay, bye.
All right, guys, great stuff from Gianni. I will say one thing. Copperbank, very small company. I've not done any due diligence on it, but I know Johnny's a huge shareholder, plans to be for many, many years, a believer in it. So just make sure you do your homework if you like the name or choose to invest in it. But I really love just his analysis on electricity just blew me away and how much he actually knew. What I loved with this interview, not just the stats on China. I mean, we hear China how big, but it's really breaking down the stats. But Gianni did a fantastic job of explaining like gigawatts and what does that mean, how many houses it powers and how much power they need. Because, you hear it a lot, especially with cryptocurrencies and data mining. And, I've seen these facilities up close at one facility, I was actually at when I took a ride from Vancouver to Washington, which is a Bitcoin data mining facility, the electricity they use, but you just hear how, wow, this is crazy, how much electricity, but you really don't put in perspective to act, and I'm glad he broke that down to make you understand it and make me understand it a little bit better. And you could see, based on the numbers, the huge demand that we're going to see for electricity. Right, we're just looking. For Consumer Electronics Show, it's not just Tesla with electric cars. So you're looking at electric cars across every single auto manufacturer. I mean, they're building these things. They're starting to look a lot nicer. So they're going to be in competition. There's nothing crazy about Tesla that can't be duplicated by these other guys when it comes to electricity and used for cars. It's a market that's continuing to take off. The technology is getting better and better. So you see it happening. You see other just demand for electricity all over the world, and how copper is a great play in it. So I thought he did a great job explaining that thesis. And I'm actually going to look at copper stocks to take small positions and maybe build up the positions over time. So hopefully you guys like that interview and also Michael's interview. Let me know at frank@curzioresearch.com. That's frank@curzioresearch.com, because I always say this and I mean it. This podcast is about you, not about me. Sometimes I'll get caught up in these interviews and be like, this is great, this is awesome, and 90% of the audience hates it. So I'll just talk to that person on the side who's, getting a lot of these thousands of people I interview are in my network, and I talk to them a lot. But I make sure when they have really good ideas of things that they can help you, I want to throw them on the podcast to see if we can all make money together. So let me know, again, if those interviews work at frank@curzioresearch.com. Okay, guys, my apologies about this super long podcast. You guys get to fast forward through the sports or one of the interviews, whatever you want to do. But I'm working hard for you. I did include these 2 interviews for you. A little bit of a market update in the intro. And also I had to talk about the Eagles winning the Super Bowl, which is awesome. But I do feel bad if you did bet the Patriots because of me. But I love to have fun with that segment because I don't know anyone who has been wrong for 8 straight years when it comes to picking the Super Bowl winner. So I just want to see you guys try to make money off of it if you can. I always like to poke fun at it. But congrats to the Eagles. I can now die in peace. So thanks so much for listening. I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.